Good afternoon to everyone. Hope everyone has been enjoying the talks, the prizes, and the game so far. I think by now you've probably heard quite a fair bit about the use in have changed over 2022, especially in Singapore, over the past few presentations. In summary, we have seen inflation overheating and it's been extending into 2023. But at the same time, we also seen interest rates spiking up to really record high levels that we didn't really expect at the start of the year. So for us, let us do something different. We are going to look at alternatives that you can actually consider before jumping into the Singapore government bonds. What you need to know before investing in SGS, SSB, and T Bills. So for today, Ting Chong will be representing the good side of SGS and SSB, Singapore Government Securities and Singapore Savings Bonds. Joshua will be representing on the attractiveness of our cash management and also auto-sweep accounts. And last but not least, the most important one, Hui Shi on the prospects of fixed income funds. The first question will be an easy one. Just a quick refresher for everyone who has just been listening over the past few presentations. How has the use exactly changed in 2022, and how do you think it will go from here?
Thanks, Daming. Maybe I can take this question first. So, since last year, we saw global interest rates rising as many economies around the world grapple with high inflation rates. So when central banks raise their interest rates, this will also lead to bond yields rising as well. So last year, we saw global bond yields rising past 3%. And this is comparing it to 2021, which it was at 1%. In Singapore as well, we also saw bond yields rising up to past 4.5% compared to 2021, where it was around 2.5%. So evidently, we can see that bond yields have surged quite significantly as interest rates rise. And right now, definitely we are in an environment of higher interest rates, and even government securities such as SSBs and T Bills are already yielding at decade high levels. So the last auction, we saw T Bills coming in at 4.2% for just only 6 months. So definitely as we tread through this higher environment of higher interest rates as well as higher bond yields, bond yields are making a comeback and are definitely looking rather attractive and interesting again.
Perhaps I can add on some of Ting Chong's points. So as we all know, clearly interest rates and yields have risen across the board, but short-term yields have actually picked up a lot higher as compared to long-term yields, which is also why you see the 6-month T-bills giving you a yield of 4%, which is higher than the SSB 10-year average of around 3%. And another thing that we notice is that the market seems to be pricing in Fed rate cuts in the second half of 2023. But we think that this is unlikely to be the case even if a recession comes. And so with this, we also expect long-term yields to move up even higher as we think that markets are underestimating the persistence of inflation. And overall, we think that interest rates should remain higher for longer, and the Fed has also expressed its intentions of doing so. And I think for interest rates in 2023, we think that it will stay at around 5%. And for the 10-year US government bond yield, I think we can expect yields to pick up as well and move closer towards the 5% level.
Right. So on one hand, right, given with the information, we are expecting the yields to stay at least around the current level or go up a little bit. But on the other hand, given how we expect there will be a global recession incoming for this year and the likelihood of a recession, do you think that the popularity of these alternatives will continue in this year?
Yeah, so definitely. So for bonds, traditionally and historically, bonds have performed well during times of recession. This is because bonds can still provide stable and reliable cash flows to its investors, despite a slowdown in economic activity as well as a recession. So definitely for bonds, we will continue to see higher demand as investors flock towards safe haven assets in order to mitigate the downside risk of inflation, and while also getting stable income from the coupon payments from bonds. For safer bonds such as the government securities, which have lesser risk, definitely for short terms, for the shorter tenor, such as T-bills or even 1 to 2 year SGSs, with higher yields right now, definitely we will see continued demand as investors take advantage of the higher of the inverted yield curve and take advantage of the higher short-term interest rates that we are receiving right now. So definitely for bonds, we continue to see higher demand, especially even during a recession.
For me, I'm from the cash management team, so it's a natural thoughts that to keep at least 10 to 20% of your positions into cash account or FSM account or auto sweep account in FSM. Just giving a simple analogy, so having cash on hand is actually having bullets with you when you enter into the jungle and aiming for your price assets. You don't want to have a scenario when you have the best weapon with you, like your research articles or your watch list or fancy charts. But if you do not have your bullets with you, how can you hunt down your price assets? Especially what Diming said, that we are actually expecting mild recessions or recessions this coming year. Yeah. So another thing about that is comparing to T bills. Okay, definitely T bills are giving you quite attractive yield at 4.2% as compared to the auto sweep yield currently at 2.7. You're actually giving out almost 1.5% yield, but if that's for per annum basis, so if you divide by 2 because of 6 months bills, so you're actually giving out 75 basis points, 0.75. But what you are missing out that there's a golden opportunities for you to go down and hunt for good opportunities when markets pull back. And you can easily make a 10-20% gains. Okay, naturally you may think, oh, okay, I don't put in T bills, I just put the money inside the bank. So when I see a good opportunities, then I go and transfer money to FSM. But this is actually equivalent to you having a weapon. You want to hunt down your price assets, but you say, oh, hey, my bullet is actually in my car boot. Let me go back to my car boot, go and recharge, reload, come back. But then your price asset has might soar 10, 20, 30%, and it becomes more dangerous for you to chase the opportunities. That's why I always advocate to have at least 10 or 20%, depending on your risk appetite, to put in the cash account at any point of time.
Yeah, for me, I think that against this kind of uncertain macro backdrop, fixed income as a whole should continue to gain interest from investors as they take on a more defensive portfolio positioning. And for bond funds, I think this is something that is still a viable option because bond funds, they are usually diversified across different markets and sectors, which helps to mitigate some of the risks. And active management is also involved, so fund managers, especially during periods of market volatility, they do have the discretion to actually take on less risk and to protect their portfolios from the market drawdowns. And on our FSM1 platform, we also do have a large number of funds available across the different risk spectrum. And I think that in particular, funds of lower risk, such as your money market or your investment grade bond funds, they should appeal more to investors in this kind of challenging environment.
Right. So very good points provided by our panelists. We have Ting Chong talking about like having our government bonds right being a lot more stable. Then we also have Joshua speaking about how liquidity is very important during this period. Also not forgetting how diversification through the funds are also very important for lower risk amidst this period. So next up, the next question might be a little bit more specific. I think there's a larger focus on investment grade issues now. Do you guys think that high yield issues will still have a place in 2023?
I think as we head into a global economic slowdown and also potentially a recession, definitely we do not advise investors to take on much credit risk. This is because, number one, I think yields have also risen quite substantially. So for investment grade yields, they are now yielding about 4 to 5%. And the spreads between, comparing the yields between high yield bonds as well as investment grade bonds, we have seen that the spreads between them have not risen to levels as seen as compared to past recessions in 2000, 2008, or even during the COVID recession. So we think that there's still room for spreads, high yield spreads to actually increase. So therefore, we don't advise investors to actually take on much credit risk and actually invest into investment grade bonds or even bonds of shorter tenors in order to mitigate interest rate risk, as they are less sensitive to changes in interest rates. So so during a recession, we prefer investment grade over high yield credits.
Yeah, so for the reasons that Ting Chong mentioned, I think from a portfolio perspective, investors should be underweighting high yield bonds in their portfolios and allocate some of this allocation towards investment grade bonds. And I think in particular, we do advise our investors to gradually reduce their positions in Asian high yield. So if you did did listen to one of our presentations earlier in the morning, we don't think that China's property market will see a recovery in the near term, despite the recent policy easing, because we think that China's property market is currently undergoing a confidence crisis. Home buyers, they are not even convinced that developers are able to deliver their homes on time. So home buyers, they're actually quite afraid to enter the housing market, and we don't think that housing prices will start to recover from here. And doing that confidence, which is now lost, is very hard to regain. And I think that recovery, a meaningful recovery, would definitely take some time, and we are still quite far away from that.
I think in a general summary for what Ting Chong and Hui Shi said, it's very important for us to really consider the risk of the current moment, and you have to really see whether if the risk to reward is worth it, especially currently seeing how we are expecting a recession. Things might change drastically in the next few months or even 1 year, so we don't exactly know. So investors really do have to take note of their risk and to see whether things are worth it. On the other hand, right, Joshua, I have next question for you, I think because you're our specialist in our cash management and auto sweep. Are there any particular currencies you might favor and recommend investors in looking at?
Disclaimer first, I'm not an FX expert, so I do not have any short-term favorable views on any FX pair. But of course, like everyone here, I really wish that SGD strengthen so that we have more purchasing power when we go to JB for shopping, or when we're buying other foreign currencies investment products, it'll be cheaper or less cheaper in SGD terms. But I think more importantly, you need to ask yourself, what is your investment objective? Are you someone that likes to invest in the US market? If yes, definitely you need to have some balances in your USD cash account. Or do you like Hong Kong market, China market? That's where you should put some Hong Kong dollars or CNH balances. Or you are someone that likes the STI counters, then definitely having SGD balance there is always beneficial. But if you're someone that likes me, that like to invest across all the universe, one good products that we have on FSM is actually the SGD Auto Sweep. So this product actually allows you to invest immediately using the balance inside, as well as give you attractive view, 2.7 now, the indicative view, as well as allow you to invest directly into all the foreign currency products. So we actually handle the FX procedures for you when your trades get filled. So you don't need to be think so much or hustle regarding the FX stuff.
Thank you, Joshua. I think ultimately we all really do hope that SGD continue to strengthen. Then we go Malaysia, can buy a little bit more things with our purchasing power. But then, coming to the last question of the day for this panel, the most important question of all, we are diving a little bit deeper into what you are representing today. After all the things that you mentioned, can you all give us one pro and one con about the product class you are representing over the conventional products, for example, like fixed deposits?
Okay, I go first. So it really depends, like what they always say, low risk, low return, high risk, high return. So putting your money into the cash account or auto sweep, it yields decently, but it's actually putting you at the lower risk spectrums. So the good thing is you don't have so much volatility as compared to your bonds funds, but at the same time, you are not so restricted if you're put inside the T bills. So there's some of the flexibilities that I think is very beneficial to having the balances in your cash account or auto sweep, so that you can use it anytime to hunt for your golden opportunities.
Yeah, so for me, for bonds, I think one of the pros comparing to traditional assets such as a fixed deposit, I think number one is the ability to sell bonds in the secondary market. So definitely investors can take advantage of the rise in bond prices. If the price of a bond rises, then definitely investors can still sell their bonds in the secondary market and before their maturity date. And also looking at the downside, this is also one of the cons because as interest rates rise, it will actually negatively affect bond prices. So in order to mitigate this interest rate risk and the volatility of bond prices during this time, we definitely do recommend investors to consider shorter tenor bonds, as these bonds are less sensitive to changes in interest rates, and this will help to mitigate some of the changes in interest rates.
For me, for bond funds, I think a con would be that bond funds are slightly riskier because the average credit quality of most of the bond funds out there, they're actually much higher as compared to relatively risk-free assets such as T bills. So there's a risk of capital loss, especially during periods of market uncertainties because of the mark-to-market impact. But I think a pro here would be that higher risk, they can potentially imply higher potential returns. If you look at, for example, the investment grade short duration bond funds that some of our fund houses here offer, they can give you portfolio yields of around close to 5%. So that's actually quite a decent yield pickup over your risk-free T-bills as well.
Okay. Thank you so much to our panelists for what you mentioned. I think a very key point for this panel that you have listened to is ultimately for us to really consider our risk profile and to see whether if the risk to reward is really there for us to really take on the risk, especially current given this period where are we considering high yields, investment grades, even the risk-free rates. Each of it has their own benefits, but at the same time, we do have to consider the risk downside, whether it will be worth it at the end of the day. Meanwhile, for Ting Chong also highlighted something very important. Ultimately, we see the government bonds as something really stable, it's always there, but we do have to consider the downside, which is the liquidity. Is the secondary market going to be easy for us to tap into the money itself? Also, ultimately, for cash management, the liquidity will be a very important point as we continue to see 2023 to be a pivoting year, whereby we might see some more opportunities in the equity market. And in terms of liquidity, we might need to tap on the cash just for that additional investments we might want to do. Once again, thank you all to the panelists, and thank you all for listening to our panel. Hope you all have gained something from what you need to consider before jumping into the Singapore government securities, Singapore savings bonds, and T-bills. I'm Timing, and thank you once again representing for all the panelists. That's all for today.
Thank you.